Now, across the stock market, there are so many different ETFs to choose from, ETFs that have various different underlying holdings, some of them that offer more income potential, some that offer more growth potential, and some that offer some of both. Now, even though there's tons of ETFs that could be great to hold on to long term, and especially during a market crash or correction, could be great to add to your portfolio even at a lower price than average. There's honestly just a few ETFs that I personally am looking to add to my long-term 7-figure dividend portfolio during market crashes and or corrections for me personally. Now, during market crashes and or corrections, when things get relatively cheap, I want to add the highest quality assets to my portfolio and maybe mess around with some more or less gamble plays when the market goes back up high. Because what I've learned over the last 8 or 9 years of my investing journey is that when things get cheap, you're going to want to add as much high quality as possible. So in this video, I'm going to share with you guys 8 different ETFs that I personally am planning on adding in 2025, and that's especially if we see continuous market corrections and crashes, etc. These ETFs are all either index-based or have super high-quality underlying holdings, good strategies that I believe in long-term, and are names that I definitely would be comfortable with holding on to a very, very long time. So if you want to see which 8 ETFs I personally think are the best during most any market conditions, well, then make sure to stick around, drop a like down below, and let's get right into it. My A to Z dividend investing ebook has helped countless dividend investors get started with their journey. And my custom dividend tracker that I'm constantly using here on the channel has also helped so many investors stay on track and allow them to see their dividend income in real time. Well, today I have another treat for you guys. I'm not only going to offer you my A to Z dividend investing ebook and the custom dividend tracker, but also just for a short limited time, I'm going to be adding in my brand new weekly dividend blueprint ebook to show you how you can get started with weekly dividend ETFs and add this into your investing strategy. This offer is not going to last long, so go ahead and click the first link down below in my description, and you're going to get both ebooks and the custom dividend tracker bundle. But like I said, please act fast because this won't be around for long. Now let's get back into the video. Now the first ETF that I definitely plan on adding, especially if the market goes lower from here, is one of my favorites, VIG, the Vanguard Dividend Appreciation ETF. Now this ETF is great because it's cheap to hold on to. It offers almost a 2% starting dividend yield, but also offers a ton of growth potential, at least it has historically. Now the ETF seeks to track the performance of the S&P's US Dividend Grower Index. The portfolio is very well diversified with around 330 different holdings. And again, some of the names are going to be much more growth oriented like Apple and Broadcom, and then some names are going to be much more dividend and dividend growth oriented. Now, VIG has been far from cheap over the past several years, and it's still a little bit expensive if you ask me. But this ETF is definitely high quality. It's offered some nice dividend growth historically, and again, inside the portfolio are some names that I definitely want to add more to in my portfolio. So ETF number 1 that I will be looking to add, especially if we see the market go lower, is going to be VIG. The next ETF that I'm planning on adding a lot more of, who would have guessed it, is my number 1 favorite ETF, SEHD. This ETF is also cheap to hold on to. It's grown consistently over time. It's pretty defensive as far as portfolio makeup goes. It's offered massive dividend growth historically and has grown nicely over time. Not to mention SEHD as of right now is currently offering a starting yield of around 4%, which is huge. This ETF will definitely be in my shopping cart, whether the market's green or red throughout the rest of this year. The next ETF, an ETF that I definitely have liked during the last decade or so that I've held onto it, especially during market crashes and corrections because of its low beta nature, is DIVO, or the Amplify CWP Enhanced Dividend Income ETF. This ETF is great because it buys into a small high quality basket of holdings, names like American Express, names like Caterpillar, high quality dividend growth names. But along with that, Divo, of course, sells covered calls and individual names, which offers the potential for income around 5% yield starting, but also the potential for downside protection. Divo is a low beta ETF that I've used time and time again historically, and I definitely will be looking to add a lot more Divo into my portfolio, especially if we see a larger pullback. The next ETFs I'm going to add a lot more to my portfolio and that I feel safe with adding because they're all index based is number 1, the GPIX ETF, the Goldman Sachs S&P 500, which seeks current income while maintaining prospects for capital appreciation. Now this ETF is going to be a little bit higher income with around an 8 or 9% starting yield. The ETF has offered consistent income historically at least, and again utilizing the S&P 500. If of course we see a recovery or a reversal in the market, this ETF should grow pretty nicely. Now just like GPIX, I'm also going to be adding more GPIQ, the Nasdaq 100 version. Again, I'm a big fan of both these ETFs because of the way the strategy works. Now if you guys are interested in seeing me go a lot deeper into any of these ETFs, I talk about them all the time on my channel, so subscribe and check out some of my other videos. But both GPIX and GPIQ see current income while maintaining prospects for capital appreciation, which means they're going to be more income focused, which can also potentially be a good time to buy more of them because if they're cheaper, that means your yield on cost could potentially go up. Now speaking of more more income-focused ETFs, I also feel very safe buying more JP Morgan, Nasdaq Equity Premium Income ETF, or JEPQ. This ETF has not really pulled back all that much over the last year or two, but now we're finally getting an opportunity to grab some more shares, probably pretty close to, if not below, our cost basis. Now, JEPQ has been amazing as far as capital preservation and as far as dividends go. I mean, this ETF alone has paid me several $100s for as long as I can remember per month. Now, the last few ETFs I definitely feel comfortable with holding through this crash, after the crash, and everything else in between is going to be SPY and, of course, QQQI. Again, because both these ETFs are index-based, the S&P 500 for SPYI, and of course the Nasdaq 100 for the other one. I've talked about these ETFs time and time again, how I personally do believe in their underlying strategy, and because I personally am building out a portfolio, which I want more exposure to the Nasdaq and of course the S&P, both these ETFs basically offer exactly what I'm looking for. Now, will both these ETFs drop if the market keeps dropping, if the underlying keeps dropping? Well, of course. And what a lot of newer investors especially need to understand is that an ETF is only as strong as its holdings. So let's say, for example, an ETF like this one holds onto all these individual stocks. If these individual stocks go down, well, guess what's going to happen to the ETF? It's also going to go down. All that to say that these ETFs, at least so far, have been very consistent in payouts. And again, because I want more exposure to the underlying, I'm going to be buying them all the way up and all the way down. So there we have it. Those are several different ETFs that I personally feel comfortable with buying through the market crashes, corrections, or whatever else that we see throughout this year. Now, like I said, can these ETFs and any other ETFs lose value? Can they go up in value? Of course they can, guys. And just because an ETF offers a 10 or 12 or 14% yield does not mean that it's a bulletproof ETF whatsoever. Every single investment throughout the stock market from top to bottom has their own risks, some more than others. So again, do your own research and figure out what matches what you're looking for as far as your strategy, as far as your objectives, and 100% as far as your risk tolerance. But for me personally, I'm excited to add more and more of my favorite names for hopefully cheaper in the next up and coming weeks. But now that I talked about several ETFs that I personally feel comfortable with buying during the crazy market conditions like we're seeing, I want to hear from you guys down below. What are some stocks and or ETFs that you're buying as of right now and probably throughout the rest of 2025? Drop the ticker symbols in my comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.